Go. Yes, we are live. Good afternoon, everyone. François Lanthier, real estate investor, full time. I quit the 9 to 5 back in November, and now I get to do what I enjoy the most: is learn about real estate, invest in real estate, and talk with great people like Charles, who's a mortgage specialist. Charles, we had a conversation last week. Really interesting stuff. I thought I'd follow it up with a bit more in-depth conversation about like lenders that are very investor friendly. So you mentioned
Right.
a few of them, and I'm very interested to find out more.
No, 100%. Yeah, last week we had an amazing conversation. And I'm so happy that we were able to follow up again, and hopefully we were able to bring the same kind of value and keep the momentum going, right?
Yes, absolutely. That would be great. So you were telling me about TD and Scotiabank, how they
Yeah,
have the biggest book of business for investors. So they're more, I guess, geared towards investors.
right, right. Most definitely. So we'll break it down. So first I'll start off with, let's say, TD. All right, and why these two, why TD is able to lure some and get a lot of people who want to buy multiple rental properties in the door. All right. Now, the reason why TD is always the best, rates. They're always one of the lowest rates. So in terms of rental properties, you're looking anywhere around 1.6, 1.65, right?
Wow.
In that ballpark range that you're able to get. And that's without buying down. So buying down sometimes on the broker side, if we need to compete with the big banks, we have the ability to actually use our commission to buy down the rates a little bit
Oh,
lower
wow.
for
I
our
have
clients.
heard that before. Yes, that's
Yeah.
cool. Well,
Now
it's
we
not
try
cool
not.
for you, but it's cool for the buyer.
Yeah, no, well, definitely. So I think 1.65 without having to buy it down, it's pretty competitive, right? So
Yeah.
that's the first thing why TD is like the law. The second reason is because once you're looking to purchase two, three, four, five rental properties with TD, they go based off of what's called a rental worksheet. So essentially, their main focus is the debt service coverage ratio, right?
Okay.
Which is right. So they want to make sure that the debt load that you're carrying with your income uh, is at least 1.2. So you're able to at least service 100% of the debt load in case something else goes wrong within the property, right?
Yeah.
Now, obviously, so 1.2 is generally the rule of thumb across the board. If it's below 1.2, they have to give you an exception. So it's based off of client to client, right? Looking at background information like their income, what's their portfolio like, right? Things of that nature. And now they're looking at everything. So they're looking at the rental income. They're looking at the expenses. So expenses being vacancy, heat, hydro, property taxes, all that fun stuff, right? If there is a shortfall, so meaning there's a negative number once you fill out the rental worksheet,
Yeah.
what we can do on our end as a broker is within the application, we just take that shortfall and add it to your expenses when it comes to the ratios.
Okay.
That's it, right? Which is obviously a lot better than including each individual property and including their expenses because obviously that's going to blow up the ratios and the deal's never going to work.
Yeah. So I'm
All right.
interested in TD then. I should talk to
Yeah.
you.
Right. Now though, TD really only works if the properties are cash flowing extensively.
Okay.
Because obviously that's going to help your DSC,
Yeah.
right?
So they want
That
cash flowing from day one.
exactly,
Yeah. Well,
exactly,
sometimes the strategy for many investors is like the BRRRR or something, it's underperforming, then you get
right.
lift. So maybe you go private, I guess, at first, and then finance with TD when it's cash flowing and you're happy with the result.
No, exactly. That's definitely an option, right? So again, DSC is the main concern with TD. Now, obviously, we have to be realistic. Given the market, it's not easy to find cash flowing properties, right?
No.
It's not easy to find cash flowing properties, which is why Scotia has put themselves in a really good position to target those properties. Now, this
Mm,
is why Scotia, personally, I would say is the best bar none. Reason being, is because they don't look at the expenses at all. They don't care about the property tax. They don't include hydro. They don't include heat, right? When it comes to buying rental properties. All they do is they take your rental income that you're collecting, all right? They take 50% of that rental income, and then they're going to subtract that by the monthly mortgage payment.
Oh, okay. Right? It's like a simplified method. Like my HST filing, I'm using the quick method. So
exactly. And then they just take that. If there's a surplus, they add it to your income. If there's a deficit or a shortfall, they add it to your expenses.
Okay.
And that, what allows you to do is it evens up the playing ground, because even though your property may not be cash flowing, but if you're being, because it's not including property tax and all these big expenditures on a monthly or yearly basis, and they're just including that small shortfall, that's going to decrease your total debt service ratios by a lot, right?
Wow. So you can buy more.
So you can buy more, exactly. In most cases, most individuals, I always go with Scotia because of that, because again, it's tough to find that many cash flowing properties.
Yeah.
Now the caveat is Scotia Smart, because they know they have such a footing in this niche product. Their rates are usually the highest out of all the big banks.
Oh, okay.
So it's not awful, but their rental rates right now are probably going for around 2.1.
Okay, right? So it is higher for sure, but it's easier to qualify. So I guess
exactly.
Pros and cons. It comes at a price.
Exactly, right? Another thing I like Scotia is they have a really good STEP program. So STEP program, HELOC program. So essentially, they'll be able to add that HELOC to your rental property, all right? And then from there, as you pay down the mortgage balance, all right, your HELOC automatically gets bigger and bigger, right? So, and that's really good because you can always just keep borrowing against it. If you're looking to invest in whatever, it could be more properties, put into your TFSAs, GICs, stock markets, etc. It really doesn't matter.
And what's really cool too, another one I learned is you can have an unsecured line of credit, and then oftentimes they offer you a credit card as well. So you get those credit cards, and after a few months, you can convert them to more space within your unsecured line of credit. So it's really crazy. So you keep topping up, and you can up the credit.
No, exactly. And all that to do what? It helps the ratios.
Yes.
Right? All that helps the ratios and bringing those ratios, the ratio guidelines down for you to qualify. Before I forget, at the top of my head too, what's really good about Scotia, they're the only bank that allows you to go over 39% GDS. So for them, it's pretty much 44-44.
Yeah.
Right? Whereas, again, TD, 39-44. So that the mortgage debt, the household debt, just the household debt has to be below 39%, right? When you're comparing it to your income. Again, which can be pretty tough when you're carrying that big of a rental portfolio.
Yeah, that's it. When it starts being a few $1 million, I mean, doesn't add up anymore.
Exactly, right? So again, Scotia giving you that extra wiggle room, knowing that people, once they get to 1 or 2 rental properties, they want to keep going, right? People want to expand their portfolio, especially now. It's hotter than ever. Real estate is the subject of real estate and real estate investing. I feel it has 10x over the last year, especially since we dove into COVID, right? So they're smart. So they put themselves in a position to capitalize and grab a lot of that business.
Yes, absolutely. And then are there other terms or conditions or something that as an investor you should consider? Because like, should you get a variable rate since you're going to be refinancing, or sometimes there's like some conditions like prepayment privileges or
right. So that's a really good question, François. So I would say first things first, especially if you're an investor, for me, it doesn't really make sense going into a fix.
No.
Now this is my personal this is my reason why. Because if you're an investor and you put yourself into a fix, right? 9 times out of 10, you're going to look to refinance at least within the next 2 or 3 years. Sometimes if you're doing a burst strategy within the next year, depending on the market, there's a lot of equity growth, etc. Right?
Yes.
why pay interest differential? Because right now interest differential is at an all-time high. I've seen people breaking terms of their mortgage almost 15K, 20K, 30K, right?
Yeah.
That's a lot coming out of the proceeds of the home, unfortunately, right?
You can't really amortize that expense, and there's nothing
exactly
giving money to the bank.
Exactly. You're just throwing away money. At least with the variable, all right, you know it's going to be 3 months interest guaranteed whenever you decide to break, all right? And at the end of the day, variables are still lower than fixed rates, right? The Bank of Canada, and we've talked about this before, already said they're keeping rates pretty steady up until 2023, maybe even a little bit more past that, right? Because at the end of the day, we have to stimulate the economy. We can't hike rates back up like they once were. Excuse me. So it's a pretty safe bet, especially if you're closing on properties this time. That's why, again, I always preach to all my clients. If you're an investor mind, investor focus, and your goal is to do a burst strategy or anything like that and keep accumulating more properties, you're always going to be in and out of those terms.
Yeah.
Go for a variable, right? The second thing you mentioned was the prepayment penalties. That's awesome as well, right? Being able to put 20% lump sum, right, payment over the course of the year of the original loan balance is huge, especially if you are, let's say you have a primary residence already, all right, and you want to keep borrowing against it. Well, putting those large payments down is definitely going to open up the equity value in the home. That way you can refinance, every couple of years or so to keep borrowing against it. So that's another really, really big advantage as well.
Yeah, and the advantage of refinancing is you're borrowing to buy more investments. So that interest you can claim instead of just interest on your own house. So
right.
That's the nice part, like on accounting. So of course we're not accountants here or lawyers. But we do have a mortgage expert here, but not in accounting. So we're just giving ideas, things we've experienced. So
no, exactly. Even me myself, because I have to admit, especially when I'm talking with an investor, right? Sometimes there's some accounting questions that come up that professionally I don't feel comfortable answering, even though I think I may know the answer. So I always call up one of my personal real estate accountant, Devin, and he's fabulous. But it's always good to add more professionals to the table just to make sure you have a seamless, process. Because again, at the end of the day, we have to try to figure out a win-win situation. I don't want to tell them to refi or sell their home or anything like that, and then have them get dinged for capital gains when it comes to tax season, and then Charles, what the heck, So
exactly, because capital gains for primary residence, that is changing. Like it's not what it used to be. So I've heard stories where people are flipping. Well, I've done it myself, slow flips, so over many years.
Right.
Buy with the intention of doing a flip, then you can have capital gain even though it is on your principal residence.
Right.
So the intention is very important. It's not just the time. Like usually it's more than a year in a house. You're safer. But if the intention from moving in is to flip and do some quick cash, then CRA can come after you and it's legal.
Exactly, right? So again, that's what's really important when we sit down. Always we have to figure out the long-term goal, because then we just have to work backwards, right?
Yeah.
And making sure we line up all the different all the nuances within the mortgage terms just to make sure it doesn't affect your end goal.
Exactly. No, that's really cool. Another feature, sometimes there's like in the mortgages, there's prepayment, like I said. You mentioned some variable interest, so it's easier to break the mortgage. But sometimes there's some other aspects to the mortgage. Like what I'm trying to remember one. Well, yeah, the STEP program. So you get a line of credit built in. Yeah, the HELOC, which is great. But I've seen something else. I can't remember what it was. There was something built in.
Yeah, no, there's a few good things, but like again, it really depends what you're looking to do, right? So even like portability, right?
Yeah, that's the one I wanted to talk about. That one can be interesting. It depends.
No, exactly, right? So it really depends. So if you're looking to simply move primary residence, right, going from one primary residence to the other, and you're moving in, or you're doing a slow flip, like you said, this would be an advantage. That way you don't get dinged on capital gains.
Yeah.
If you're looking to sell your home and then move into another primary residence, instead of breaking the terms, if you're doing it with the same bank, and that's very important, it has to be with the same bank, you simply just take the same mortgage and you just port it onto the new home. That way you don't have to pay the breaking penalties or fees, right? Which could be massive, can be like 15, 20K. So you're saving that money. That's not necessarily part of like the actual mortgage when you sign the papers or terms, but it's just a feature or option that, oh, I'm looking to buy a new primary residence. If it's with the same lender, again, TD does this very, very well, that they're able to port that mortgage for you onto the next property without actually paying the breaking penalties or fees.
And I've heard as well, like in other provinces, I know you're in Ontario, but like in Alberta and other provinces, people can actually assume the mortgage. So you can sell the property with the mortgage. So let's say you had an awesome mortgage product, then the new owner can assume it. Here, it's not something you do in Ontario.
No, here's not. That would be on fire if it was, right?
Yeah, but imagine that if not like rate at 1.5, and then the new owner, I think you don't even need to qualify. Something crazy. The rule, it's attached to the property. I don't know all the details, but
no, that's interesting. I've heard of that feature as well, but personally, I haven't dove deep into it because again, it's not applicable here in Ontario.
No.
So I haven't really come across that option.
But for investors, it might be something to explore. I'm curious. I'll have to reach out to someone out there and find out more about this.
For sure. I'm closing up a deal, hopefully, knock on wood, out west. So I have a few mortgage specialists out there I'm going to have to reach out to because that is definitely interesting, especially if you're looking to invest in out of province, right?
Yeah, that's it.
If the seller is willing to, work with you and have a little bit of wiggle room, why not? Why not?
Cool. Well, that brings me to the next step of this conversation. So I thought we should talk about B lenders. So we talk about A lenders, TD, Scotia, they're amazing. But what about B lenders? And maybe name those companies because people are like, B lenders, what does that mean? Is it a shady deal? Not at all. They're big, reputable agencies, and sometimes they have some great conditions, and again, better option too. So
for sure. So I will say this: I don't like saying B lenders just for the reason you just said, because people are like, oh, whoa,
alternative lenders.
Yeah. So I like to say alt A, right? Alternative A lenders, because they do offer, honestly, a lot of the same products that the A lenders do. And they just give you a larger ratio, so more wiggle room to qualify. Now, obviously, with B lenders, one thing is you have to put 20% down, right? Yeah. That's generally a non-negotiable.
But for investors right now, that's pretty much it, no matter what. I mean,
exactly. Now, some of the main B lenders right now on the market that I say are, again, really dominating the numbers in terms of grabbing up all the business is Equitable, all right? Community Trust is another one, Optimum, and then a sleeper that just came out, Bridgewater Bank. And I'm kind of going to detail why each of them are really special and what type of products they offer. So across the board, I want to tell people in terms of B lenders, the reason why you want to at least consider it, maybe not close, but at least consider that as an option, is because right now rates for the B lender side, they just dropped to about 2.5, 2.6.
Yeah, it's crazy low for what it is. I mean, it's still very cheap money.
Exactly. Like, just think about it. I know there's people in mortgages right now on the A side who are still at 2.9, 2.8%, depending if they closed right before COVID, right? So it's still really low. On top of that, with alternative lenders or B lenders or Alt-A, that, as we're saying, is sometimes they don't even show up on your Equifax report.
Nice. That's what we like to hear.
Right? So again,
Meridian, if you do commercial, you can, anyway, somehow it doesn't appear on your credit reports.
Yeah. So that's going to allow you to consume more properties, again, obviously with different lenders, different alternative lenders, but they'll never see that on your Equifax report when you pull your credit. All right. So that, again, your debt, your liabilities, your expenses, all that stuff is not included in the ratio.
Wow.
Right? So those are those are the main reasons why I like to at least flirt with the idea of closing on the B side. But
Yeah.
just to get more specific, we'll start off with equitable. All right, equitable is really good for those who are self-employed. All right,
Yeah. Like
like
me,
we,
you know?
yeah, no, like you now. So they will consider and make an exception based off of your NOAs, T1 generals, and the business itself. They may consider approving a mortgage for an individual who's self-employed if they haven't been self-employed for 2 years,
Yeah.
which is, again, rule of thumb on the A side, 2 years self-employment, that there's no ways around that. No ifs,
Okay.
ands, or buts, right? Another thing, equitable, because they have such a large pool of money at Equitable, they're willing to do really big projects like million, $2 million worth of mortgages easy. So if you're someone who's looking to purchase or do a big project or purchase a big property and you're self-employed, Equitable is already the way to go. A lot of those other alternative lenders um, really don't have the capability, the capacity to lend on that extent. Where you look at $2, $3 million properties, right? Because those are big mortgage amounts that you're asking
Yeah, for
for.
sure.
So that's why I like Equitable, especially if you're self-employed, right? They give the most exceptions and things of that nature, which is great. But similar to Scotia, because they know this, the rates among the B lenders are generally a few ticks high.
Yeah.
That's how they get you. When it comes to community and optimum, I love for real estate investors. Reason being, remember how I told you Scotia goes about 50% rental offset in terms of take 50% of the rental
Yeah.
income?
Yeah.
They go up to 90%,
Oh my goodness. Wow.
right? So that pretty much takes in
That's
the whole rental income, takes off the expenses, and chances are you're going to have a surplus if you have a decent rental property.
yeah.
And then we just take that surplus, add it to your income, which obviously bolsters your income, and you're able to again flirt within the ratios, bring them down, and get qualified that way. Now, sorry, we didn't mention in the beginning. If you want to understand the ratios on the B side, they go up to about 48-50. So 48 GDS, 50 TDS.
Okay,
So you
much
have,
clearer.
yeah, so you have way more room now, way more exposure to go and buy multiple properties.
Wow. But then for to be approved, usually they ask like they need a bit more proof for the deposit. They want 3 months of bank statements and
Yes,
a
but
few.
honestly, to be honest with you, Francois, with the way COVID's going now and how many people, because the banks they're smart. They know that people are getting to real estate investments. So
Yeah.
so now they want to see 3 months proof of deposit in terms of where the down payment is coming from.
Yeah. Just poof, it's in your account.
Proof it's in your account or your JV partner's account or whatever the case may be,
Yeah.
right? So that's almost, I would say honestly, I've seen that with Scotia, I've seen that with TD.
Oh,
That's almost standard across the board now. Now obviously there's ways around that, right? Just
yeah.
have it in a little bit earlier,
That's
and
it.
then it doesn't matter. But generally they're going to ask for 3 months 3 months bank statements regardless of what side you're on.
Okay.
Um, Now, community trust specifically, and this is the community trust, what they allow us to do at community is, again, if you're self-employed, but let's say you had a rough year due to COVID, which is completely normal. But these last 6 months, your business has picked up right back up again, and you're
Okay.
looking to buy a property. What I'm able to do is actually take the 6 months and annualize that for the full year and make
Nice.
it seem like that's your full year's worth of income in order to qualify the deal.
That makes a big
Right?
difference, especially
That
for
makes it
some businesses that had to shift or pivot to online and now they're doing
exactly,
well, but they had a major dip. So that's great.
exactly. And I've seen even as low as 3 months,
Oh wow,
right?
three
Like
months.
so, yeah, and we've been able just to annualize that over the year, which obviously helps a lot. If the last 9 months or the 9 months prior to that, your business was really wasn't doing well. Excuse
Yeah.
me, right? So that is something that pertains to community trust that I like a lot. And community trust is another one that's pretty friendly with the rates. Right now they're around 2.7 ish. All right, in that ballpark in terms of qualifying a deal.
And it's the
Again,
same community trust where you can have self-directed RSPs and all that?
Yep,
Yeah.
correct.
So they also
Correct.
do lending. I didn't know that part, so that's nice.
No, yeah. Again, and these are some of the tips and tricks that a lot of people don't know that you're able to use on the B side, right?
Yeah.
But I think it's just because the name, honestly, it just turns people away, right?
Yeah, they're like, oh, this is obscure marketing. I mean, they do their job. And Scotia are right, left, and center. RBC, they have some special programs. You always hear the bigger names. The other ones, they're not as common, but that's why we need to work with someone like yourself. So someone that's got that works for a brokerage firm and not specifically for a bank.
Banking institution, correct.
Deal for your clients instead of applying to each bank and then, oh, yes, no, maybe. And so
no, exactly. And then there was one more B lender, which was Optimum, that I want to touch on.
Yes.
Optimum. Now, Optimum, I would say in terms of holding a lot of rental properties, they're barring along the B side the best. They have a rental worksheet. All right, they do the same thing in terms of they look at the debt service coverage ratio. They look for about 1.1 to 1.2 is generally the rule of thumb. And similar to TD, they similar to Scotia, my apologies. They don't take similar to TD, they do take into consideration the expenses, right? When you're trying to get that DSC, but whatever the shortfall or surplus is, when I put it into my system to qualify the deal, I don't have to include the expenses, like the property tax, the heat, all that fun stuff. But just either the addition to the income if there's a surplus, or if there's a shortfall, I just add that to the expenses in either the monthly or yearly category, and we qualify the deal that way, right? So it really eliminates the big bulk of that debt load that's bringing down your ratio. So that's why Optimum is another great lender for on the B side.
That's amazing. Your wealth of knowledge. Thank you so much again for coming on at Market Mayhem. So I actually stole the title from you, but I think it's going to stick.
No. Keep it. This is for everyone to use. I love it.
Yeah, no, that's fun. And again, if people want to reach out to you, what's the best way to contact you?
Oh, beautiful. So again, the best way to contact me, you can either send me an email or you can even call my personal number. My email is Charlie, Charlie, last name Kayitaba, Kayitaba @gmail.com. All right, so Charlie Kayitaba @gmail.com. Or you can just simply reach out to my personal cellular phone. Call or text is fine, 905-246-8799.
Amazing. And what firm do you work for?
So I work for Money Tree Lending Group. All right.
Oh, Money Tree, nice. That sounds good.
Money Tree Lending Group. Yeah. So it's just a smaller brokerage firm just outside of just on the cusp of Mississauga, Oakville. So we do everything from residential to commercial. We have a personal commercial financier that's in the brokerage itself, and we are the largest commercial financier under BMO across Canada. So that's something where we start to pick up as well a lot in terms of commercial properties, businesses, all that fun stuff. Because you can imagine over COVID, right? We've been really busy on that end as well. So Money Tree Lending Group, that's where it is.
Amazing. Thank you so much. And I hope people got value out of this conversation. And it's been a pleasure. You'll have to come on again in the future.
No, 100%. And as long as the invitation is there, I'm always willing to come on and speak with you and your audience, François.
Excellent. Have a good afternoon.
Awesome. You as well. Thank you again.
Bye.
Bye-bye.